Imagine a place where land stopped being land, where dirt was no longer dirt but a financial instrument, where grass, gravel, and silence were treated like gold bars, where price no longer reflected use, productivity, or reality. In 1989, that place was Tokyo. At the center of the city sat the Imperial Palace, ancient trees, empty paths, no skyscrapers, no factories, no offices, no innovation. And yet, on paper, the land beneath it was worth more than all the real estate in California combined. Not Silicon Valley, not Los Angeles, all of it. That single fact tells you something important. This was not optimism, this was not confidence, this was not growth. This was a system that had lost its anchor to reality. By the late 1980s, Japan looked unstoppable. Its companies dominated electronics, cars, shipbuilding, and precision manufacturing. Japanese brands were everywhere. Japanese money was everywhere. Executives flew first class across the world. Glove Club memberships sold for millions of dollars. Art auctions were flooded with Japanese buyers. American landmarks were purchased like souvenirs. Rockefeller Center, movie studios, office towers. The world didn't just admire Japan, it feared it. Magazine covers asked whether Japan would dominate the 21st century. American executives visited Tokyo like anthropologists studying the future. Hollywood rewrote its villains. The enemy was no longer ideological, it was corporate, efficient, Japanese. And at the heart of it all was the market. The Nikkei stock index climbed relentlessly, 30,000, 35,000, almost 39,000 points. Every dip was bought, every warning was dismissed, every skeptic was laughed at. Land prices didn't just rise, they multiplied, tripled, quadrupled, then stopped being measured in human terms at all. Banks handed out loans with little hesitation. Corporations stopped focusing on profits from products. Why manufacture more efficiently when asset prices rose faster than any factory ever could? Accountants replaced engineers as the most powerful people in the building. Japan didn't feel rich. Japan felt invincible. And that is the most dangerous psychological state an economy can reach. Because when prices only go up, caution looks like ignorance. When everyone is getting wealthy, restraint feels immoral. And when reality finally intervenes, it doesn't knock, it collapses the floor. On December 29, 1989, the final trading day of the decade, the Nikkei peaked. There were no alarms, no emergency broadcasts, no sense of ending. People went home for New Year's celebrations believing the future was secure. Then, quietly, the system began to fail. What followed was not a correction. It wasn't even a crash in the way most people understand crashes. It was worse. The market didn't bounce. It didn't reset. It didn't recover. It sank and stayed there, month after month, year after year. Stocks slid steadily downward. Land prices froze, cracked, then declined in slow motion. The wealth that had existed mostly on paper began evaporating, not in dramatic headlines, but in silent balance sheets. Fortunes disappeared without spectacle. Careers ended without announcement. Shame replaced pride behind closed doors. Japan entered what would later be called the lost decade.
But that name was wrong. Because it wasn't a decade, it was a generation. Even today, more than 30 years later, Japan's stock market has only recently returned to its 1989 level, not adjusted for inflation, not adjusted for missed opportunity, just the same number. 34 years. To understand how devastating that is, imagine investing at the peak and waiting more than 3 decades just to break even, while the rest of the world compounds, innovates, and moves forward without you. But here is where the story becomes uncomfortable. Because the explanation most people accept is also the one that protects them. They say Japan got greedy. They say people became irrational. They say bubbles are just human nature. That explanation feels safe, because if it was madness, then it was unique. If it was stupidity, then it can be avoided. If it was emotional excess, then discipline will save us. But Japan's bubble was not spontaneous. It was not an accident. It was not mass hysteria. It was engineered. Quietly. Gradually. By people who believed they could control outcomes better than markets ever could. To understand the collapse, you have to rewind, not to Tokyo, but to a hotel ballroom in New York City. September 1985, the Plaza Hotel. 5 nations sat around a table, not celebrating, not negotiating prosperity, panicking. The US dollar had become too strong. American factories were shutting down. Imports were flooding the market. Washington wanted relief. The agreement they reached that day would reshape the global economy and plant the seeds of Japan's greatest crisis. The Plaza Accord forced the dollar lower and pushed the Japanese yen sharply higher. For the United States, it was a victory. For Japan, it was an economic shock. Japan did not run on consumption, it ran on exports. Cars, electronics, machinery, and almost overnight, those exports became dramatically more expensive to the world. Factories slowed, margins shrank, confidence wavered. In Tokyo, policymakers faced a terrifying possibility: stagnation. They needed growth, they needed momentum, and they needed it fast. Lowering interest rates was the obvious move, but it wasn't enough. So they chose control. And that choice would distort not just markets, but behavior, incentives, and eventually the psychology of an entire nation. In the next part, we'll look at a policy most people outside Japan have never heard of. A quiet bureaucratic mechanism that forced banks to lend, punished restraint, and transformed credit from a tool of growth into a weapon against reality. A policy that didn't just allow the bubble, it demanded it. Lowering interest rates is a blunt tool. Every central bank knows this. You lower rates, borrowing becomes cheaper, spending increases, and if everything works as planned, growth follows. It's indirect, imperfect, and full of uncertainty. Japan decided uncertainty was unacceptable. Instead of influencing behavior, policymakers wanted control. So they went further than almost any major economy ever had. They didn't just make borrowing cheap, they ordered borrowing to happen. This policy was called window guidance.
And outside Japan, almost no one understood what it really meant. In the United States and Europe, central banks operate at a distance. They set interest rates, provide liquidity, and let commercial banks decide who gets loans and who doesn't. Risk assessment remains decentralized. In Japan, that line was erased. Senior executives from major banks were summoned into private rooms at the central bank, not for discussion, not for debate, for instruction. They were told exactly how much their institutions were expected to increase lending that quarter. Not suggestions, not targets, quotas. And in the late 1980s, those quotas were extreme. Banks were ordered to expand lending by 15%, sometimes 20%, year after year. Whether good borrowers existed or not was irrelevant. If a bank hesitated, if a manager argued that the economy couldn't absorb that much credit safely, the consequences were understood without being written down. Access to central bank support could disappear. Careers could stall. Institutions could be quietly sidelined. Compliance was not optional. So banks complied. But compliance came with a problem. You can't force lending without destroying standards. At first, banks lent to solid companies, then to real estate developers, then to anyone who owned land, then to anyone who could borrow against land, then to anyone connected to someone who owned land. Risk assessment stopped being about cash flow. It became about collateral, and collateral was rising every month. Land prices went up, so land became safe. Rising land justified larger loans. Larger loans pushed land prices higher. Higher prices validated previous loans. This loop fed on itself. And because the central bank demanded ever-increasing loan volumes, the loop could not slow down. Credit stopped being fuel for productivity. It became fuel for prices. Corporations noticed something disturbing. They could make more money speculating than producing. Why invest in research? Why optimize manufacturing? Why compete globally? Borrowing was cheap. Assets were rising. Returns were guaranteed until they weren't. Manufacturing firms quietly transformed into financial entities that happened to make products. Balance sheets swelled. Debt exploded. Leverage became strategy. And something subtle but deadly happened. Debt stopped feeling dangerous. Inside the economy, caution became a disadvantage. If you didn't borrow, competitors would. If you didn't speculate, shareholders questioned leadership. If you stayed conservative, you fell behind. Risk-taking wasn't rewarded. It was required. By the late 1980s, the bubble had moved beyond psychology. It was structural. Even people who understood it was unsustainable were trapped inside it. Because when the system itself demands expansion, refusing to play means exiting the economy entirely. Inside the central bank, not everyone was blind. Some officials saw the excess clearly. They knew asset prices were detached from reality. They knew leverage was out of control. They knew the system was becoming fragile. But they also believed something else, that the old Japanese economic model was broken. For decades, credit had flowed through political channels. Large firms were protected. Inefficient companies survived. Stability was prioritized over competition. Reformers believed this arrangement had reached its limit.
And they believed only a crisis could dismantle it. Gradual reform was politically impossible. Powerful interests would resist. The system would protect itself, unless the pressure became overwhelming. So the bubble was tolerated, then encouraged, then expanded. Not because leaders were ignorant, but because some believed destruction would be cleansing. If the bubble grew large enough, if the excess became undeniable, then resistance would collapse under its own weight. The old order would break. A new system could emerge. That was the theory. But theory rarely survives contact with reality. By 1989, the economy had crossed a dangerous threshold. Asset prices were so inflated that even small changes in conditions could trigger collapse. Debt levels were so high that refinancing was essential for survival. Cash flow no longer mattered. Only access to credit did. And access to credit depended on interest rates. That made the system extremely sensitive. It only worked if borrowing stayed cheap forever. That assumption would prove fatal. In late 1989, leadership at the central bank changed. The new governor was known for discipline, for intolerance of excess, for concern over inflationary psychology. He looked at the economy and saw arrogance. Million-dollar golf memberships, corporations drunk on paper wealth, a society convinced prices could never fall. And he decided the experiment had gone too far. Interest rates did not rise slowly, they jumped. The message was clear. The inflationary mindset would be crushed. And when rates rose, the machine seized. Speculators who depended on rolling over debt suddenly couldn't. Loans that assumed endless refinancing became traps. Companies that had borrowed heavily to buy assets were forced to sell. At the same time. That is when bubbles truly break. Not when prices stop rising, but when everyone needs to exit together. The myth that land never falls shattered. The belief that Japan was different collapsed. The illusion of control evaporated. Prices didn't crash overnight. They slid, relentlessly. Stocks fell, then fell more, then kept falling. Within 2 years, the market had lost more than half its value. Real estate followed, more slowly, but far deeper. And only then did the true damage reveal itself. Because prices can fall. Debt does not. A developer might owe 10 billion yen on land now worth 2. A corporation might be technically bankrupt. A bank might be insolvent. In a normal system, this is where failure clears the rot. Bankruptcies happen. Assets reset. New competitors rise. Japan refused. Foreclosures were discouraged. Losses were hidden. Banks were quietly told to pretend recovery was inevitable. So they did. Bad loans stayed on the books. New loans were issued just to service old ones. Companies that should have failed were kept alive artificially. They became zombies. They didn't grow. They didn't innovate. They existed only to pay interest. And because banks were busy feeding the zombies, they had nothing left for the future. No capital for startups. No risk for new ideas. No room for renewal. The economy didn't collapse. It froze.
And that freeze would define everything that came next. From the outside, Japan did not look like a country in crisis. There were no bread lines, no riots, no collapsing cities. Trains still ran on time. Streets were clean. Crime remained low. Daily life continued with quiet discipline. And that appearance was not accidental. It was the result of a deliberate choice. When the bubble burst, Japan faced the same dilemma every financial system eventually faces after excess: allow failure or suppress it. Failure is violent. It is loud. It creates unemployment, bankruptcies, and social anger. But failure also clears the system. It forces losses to be recognized. It allows new firms to replace old ones. It resets prices, incentives, and expectations. Japan chose the other path. It chose stability. Banks were quietly discouraged from foreclosing. Corporate bankruptcies were avoided whenever possible. Losses were hidden through accounting flexibility and regulatory patience. On paper, the system survived. In reality, it began to rot. The companies that should have failed didn't disappear. They lingered. These firms could no longer compete. They had no profits. They had no future. But they were kept alive through continuous refinancing. New loans paid interest on old loans. Old debts were rolled forward indefinitely. Banks pretended assets were worth more than they were. These companies became known as zombie firms. They were not alive in any meaningful sense, but they were not allowed to die. And zombies have a cost. They consume capital. They suppress productivity. They block competition. Banks tied up their balance sheets supporting companies that could not grow, innovate, or hire aggressively. That meant fewer resources for startups, fewer opportunities for young entrepreneurs, fewer chances for renewal. The past crowded out the future. And because this process was slow, quiet, and bureaucratic, most people didn't notice it happening. Japan did not crash, it stalled. Year after year, growth hovered near zero. Wages stopped rising. Productivity gains slowed. Risk-taking evaporated. The economy entered a state that economists would later struggle to name. It wasn't recession. It wasn't depression. It was paralysis. This paralysis had consequences far beyond spreadsheets. because economies shape behavior. And when an economy stops rewarding effort, ambition adapts. Young people graduating in the 1990s entered a job market that no longer offered security. Lifetime employment, once a pillar of Japanese society, began to erode. Full-time positions were replaced with temporary contracts. Part-time work became permanent. Career paths disappeared. This cohort became known as the Ice Age generation, not because of climate, but because opportunity froze. These young workers did not rebel. They did not protest loudly. They adjusted. They delayed marriage. They delayed children. They delayed home ownership. They delayed consumption. Why borrow when debt had destroyed their parents? Why commit when stability no longer existed? Why take risks in a system that punished failure but no longer rewarded success? This shift was rational, but it was devastating. As consumption slowed, prices began to fall. Not once, not briefly, year after year.
Deflation arrived, and deflation is poison to a modern economy. When prices fall, waiting becomes logical. If something costs less tomorrow, you postpone buying it today. Multiply that logic across millions of people, and spending collapses. Businesses stop investing, consumers stop consuming, cash becomes king. The economy tightens like a fist. The central bank responded the only way it knew how. Interest rates were slashed. Eventually, they hit zero. For the first time in modern history, a major economy entered a zero interest rate environment. The theory was simple. If borrowing is free, people will spend. If money costs nothing, investment will return. But theory collided with fear. Businesses didn't borrow. Consumers didn't spend. Banks didn't lend. Everyone hoarded cash. Because when the future looks unstable, even free money feels expensive. So the central bank went further. They created money directly. In the early 2000s, Japan pioneered a policy that would later become global: quantitative easing. The central bank began buying government bonds with newly created money, flooding the financial system with liquidity. The goal was to force money into circulation, to spark inflation, to restart growth. They printed trillions, and almost nothing happened. The money stayed inside the banking system. It flowed into financial assets. It leaked overseas. But it did not reach wages. It did not revive consumption. It did not restore confidence. Japan had fallen into a trap, a balance sheet recession. Everyone was focused on paying down debt instead of expanding. Even healthy companies became conservative. Risk vanished from the system. And without risk, economies stagnate. Japan became the world's first modern example of what happens when excess is never fully resolved. Other nations watched closely. Some learned. Others dismissed it as uniquely Japanese. They said Japan was different, that its culture valued harmony, that its demographics were unique, that its mistakes could not be repeated elsewhere. That assumption would later prove dangerously wrong. But for Japan, the damage was already done. The crisis moved beyond economics. It became psychological. A generation learned that effort did not guarantee reward, that loyalty did not guarantee security, that the system would protect institutions, not individuals. Ambition became dangerous. Desire became suspect. Minimalism became survival, not as a lifestyle choice, as a defense mechanism. This is the unseen cost of prolonged stagnation. Not just lost output, not just lost wealth, but lost momentum. A society that once believed it would dominate the century began managing decline with quiet discipline.
The bubble didn't just burst, it reshaped expectations. And once expectations change, recovery becomes exponentially harder. Because growth is not just numbers, it is belief. Belief that tomorrow will be better than today. Belief that effort will be rewarded. Belief that risk is worth taking. Japan lost that belief, and the longer it stayed lost, the deeper the freeze became. What came next would lock the system in place even further. Because when stagnation persists long enough, even extraordinary measures start to feel normal. And Japan was about to cross a line no major economy had crossed before.
For years, Japan's response to stagnation followed a familiar pattern. Cut rates, add stimulus, wait for recovery. Each time the recovery failed to arrive, the response grew larger. By the early 2010s, it was clear that traditional tools were exhausted. Interest rates were already at zero. Debt was already massive. Growth was already stagnant. So Japan crossed a line no major economy had crossed before. The central bank stopped trying to influence markets. It replaced them. The Bank of Japan dramatically expanded its purchases of government bonds, not to stabilize volatility, not to smooth liquidity, but to permanently suppress interest rates. The message was explicit. Yields would stay low no matter what the market wanted. To enforce this, the central bank promised to buy unlimited quantities of government bonds whenever yields rose above its target. This policy became known as yield curve control. In practice, it was price fixing. If the price of money is fixed, markets stop communicating information. If risk is suppressed, misallocation becomes permanent. If failure is impossible, renewal disappears. But the consequences went even further. Over time, the Bank of Japan accumulated more than half of all outstanding Japanese government bonds. Think about that. The central bank became the dominant lender to its own government. At that point, the bond market stopped being a market. There was no price discovery, no warning signals, no discipline. But bonds were only the beginning. To stabilize the stock market, the central bank began buying equity exchange traded funds. At first, it was framed as a temporary measure, then as a necessary one, then as permanent policy. Year after year, purchases continued. Eventually, the central bank became one of the largest shareholders in most major Japanese corporations, not an investor seeking returns, not an owner seeking innovation, but a buyer seeking stability at any cost. Capitalism, as a system of risk, reward, and failure, quietly dissolved. This was not socialism by ideology, it was socialism by exhaustion. The system could no longer tolerate collapse, so collapse was eliminated entirely. Zombie companies survived indefinitely. New competitors struggled to emerge. Productivity stagnated. Wages remained flat. And beneath it all sat a growing, inescapable constraint: debt. Japan's national debt climbed past 250% of GDP, the highest in the developed world. As long as interest rates stayed near zero, the illusion held. But the math was unforgiving. At just 2 or 3% interest, debt servicing would consume the government's entire budget. That meant rates could never rise, not gradually, not temporarily, ever. The central bank was trapped. If it stopped buying bonds, yields would rise. If yields rose, the government would become insolvent. If the government became insolvent, the entire system would collapse. So the money printing could not stop. And systems that cannot stop decay. For years, this trap remained hidden. Inflation was low. Global conditions were calm. The currency was stable enough. But then, the outside world changed. In the early 2020s, global inflation surged. Interest rates rose across the world. Investors demanded higher yields.
Markets tested Japan's resolve. They sold Japanese bonds. They demanded compensation for inflation risk. The Bank of Japan responded exactly as promised. It printed money in unlimited quantities to buy bonds and defend its targets. Mechanically, it worked. Economically, it broke something else, the currency. As yen flooded the system, its value fell sharply. Against the dollar, the yen dropped to levels not seen in decades. For an export-driven economy, currency weakness can sometimes help, but Japan was no longer export-driven. It was import-dependent. Energy, food, raw materials. As the yen weakened, import prices surged. Electricity bills rose. Gas prices climbed. Food costs increased. Wages, frozen by decades of stagnation, could not keep up. The cost of living rose. Purchasing power fell. Quiet sacrifices multiplied. Portions got smaller. Discretionary spending vanished. Savings eroded. The people began paying the price for a system preserved too long, not through panic, through erosion. This was the final stage of the crisis. Not a crash, not a headline, not a dramatic failure, a slow transfer of wealth. From workers to balance sheets, from the future to the past, from society to stability. The institutions were saved, the system survived, but the citizens absorbed the cost. And this is where the story stops being uniquely Japanese, because every developed economy now faces the same constraints: aging populations, rising debt, central banks pushed into permanent intervention. Japan is not an anomaly, it is a preview. It shows what happens when consequences are delayed long enough to become irreversible. And it raises a question that has no easy answer. When the next bubble bursts, and it will, what choice will be made? Allow failure and renewal, or suppress it, freeze the system, and manage decline? Because one path is painful, and the other lasts forever. There are two ways an economic system can fail. One is loud. Markets collapse, banks fall, unemployment spikes. Pain is immediate and visible. The other is quiet. It stretches over decades. It hides behind stability. It feels manageable until it becomes permanent. Japan chose the second. When the bubble burst, policymakers faced a brutal decision: allow the system to break and rebuild, or freeze it in place and manage the decline. They chose harmony over chaos, stability over renewal, control over uncertainty, and in doing so, they made a moral choice. They decided who would bear the cost, not the banks, not the political institutions, not the corporate order. The cost would be paid by time, by younger generations who would never experience momentum, by workers whose wages would never rise, by a society that would slowly forget what growth felt like. This is the true tragedy of the Japanese asset bubble. Not that people got greedy, not that prices rose too high, but that once the illusion collapsed, leaders were too afraid of disorder to let reality do its work. They saved the zombies and sacrificed the future. You can see the scar everywhere. The salaryman of the 1980s believed effort led to reward.
He worked brutal hours, drank expensive whiskey, and imagined he was building something permanent. His children learned a different lesson. They watched debt destroy reputations. They watched loyalty fail. They watched institutions protect themselves. So they adapted. Desire became dangerous. Ambition became naive. Minimalism became survival. Not as a lifestyle trend, as a defense mechanism. Japan's economy still functions. Trains still run. Cities remain clean and safe. And some argue this proves the experiment succeeded. That Japan avoided revolution, avoided mass homelessness, avoided social collapse. Maybe. But what was lost cannot be measured in GDP. A nation that once believed it would dominate the century
now manages decline with quiet discipline. This is the unseen cost of financial manipulation. Not just mispriced assets, but mispriced life choices, delayed families, abandoned ambitions, a generation taught that wanting less is safer than wanting more. And this is where the story turns outward, because the parallels are no longer subtle. Asset bubbles fueled by cheap credit, crashes met with zero interest rates and money printing, zombie companies surviving on borrowed time, central banks growing into permanent market actors. Japan did not invent these problems. It encountered them first. Not because it was foolish, but because it was early. Today, many economies face the same dilemma Japan faced in 1990. Debt levels too high to reset, systems too interconnected to fail, pain too politically dangerous to allow. So the machines stay on. Money is printed, rates are suppressed, reality is postponed. But reality is patient. The lesson of 1989 is not that bubbles are bad. It is that avoiding consequences does not eliminate them. It spreads them across generations. Japan traded a sharp reckoning for a slow one, and more than 30 years later, the bill is still arriving. The party ended decades ago, but the lights were never turned off. And somewhere inside that endlessly managed economy, there is a question the world has not answered yet. When our moment comes, will we let the system fall and rebuild, or will we choose to freeze time and live inside the ruins? Because one path is painful, and the other lasts forever.